Soltani. I grew up in Orange County, went to school up in Santa Barbara, came back down here, and since I've been back, I've been working as a life insurance specialist. So, why I got into life insurance planning, there's not every typical 22, 23-year-old that says, you know what, I want to do life insurance, right? Not the most exciting, really, job, but the reason I got into it is I actually experienced a life insurance moment in my life when I was younger. When I was about 10 years old, my grandfather had passed away. And one of the things that being 90 years old, an older gentleman, hide my money under the bed in a shoebox kind of type of guy, he never planned for his actual passing. And that was something that actually the burden fell on our family. My dad being the oldest in the family, what happened was we actually had to start digging and collecting and asking people to contribute to this funeral because my family is spread out over three continents and 4 different countries. So to get everyone back to where we needed to be, it's very expensive, and there's extended families. So the cost to have this funeral ran up pretty quickly. And if there would have been life insurance in place, what would have happened is that policy would have paid out, the burden wouldn't have fallen on the family, and we would have been able to take care of everyone and bring everyone that couldn't make it to the funeral there. So that was the first time I ever experienced it. Now, at that time, I didn't know what life insurance was. As I got older, one of my friends, when I was 16, his grandpa passed away. And he said, well, actually, we're flying the whole family out to Florida to take care of the funeral. And I was thinking, well, isn't that a lot of money? Isn't your dad going to pay a lot? Because I experienced that. He said, no, my grandpa had a life insurance policy for $500,000. We paid off all his debts. There's money left over for the grandkids. I'm actually getting $25,000 towards my college plan. And now we're flying the whole family out to Florida. That right there was something that was eye-opening to me because I never knew there was such a thing. So that kind of sparked my interest in life insurance and what it can do for you, because there's no type of policy that you can put into that has such a great payout for such a low amount that you put in it. Now, the thing with life insurance, it's a defined amount for an undefined period, but that's why you have it in place, is for that undefined period, because you don't know when your passing will be. 2 clients that I have right now that I'm taking care of, their spouses passed away. One, her name is Terry, her husband Michael. We put a life insurance in place. He actually had pancreatic cancer and passed away about a year ago. And the thing that happened is we had a $500,000 policy in place. With that $500,000, we paid off all their outstanding debts. She is now debt-free, and she's collecting off of that life insurance that we reinvested for her. More than she was actually making with her income with just working. The other client I have is Carol Perkins, who passed away in March of this year. Her husband, we set up a life insurance policy in place as well. He's now going to be making about $150,000 a year with his pension, her pension, and the life insurance that we put into place. Now, of course, there's no dollar amount that will ever replace Carol, but what we've done at this point is now made him not worry about his income for the rest of his life. His biggest problem now is that there's too much money coming in too quick. So next month he's taking his whole family on a cruise. He got $30,000 out. He's taking the whole family on a 7-day cruise through Florida and all the Caribbean. So those are the success stories that I set up for people, and no one ever thinks about life insurance until it actually happens. And that's why today I want to talk to you guys about the different types of life insurance. So if you look at the pamphlet in front of you, there's tons of life insurance out there, and there's different types for each type of person. So the most basic type of life insurance you'll see is in the top left, which is called a term insurance policy. So term insurance is much like car insurance. You pay a premium, you have a set period of time, and if anything ever happens, that policy pays out to your family. So who would be a good candidate for term insurance? Well, young families. I just set up a family who bought their first home, had their second child, and is now looking to buy actually another property. So what we did for them is we put a term insurance policy. They're 35 and 33. For them both, their total amount of premium is $72 a month, and they have $1 million of coverage on each other for the next 20 years. So now what we've done is we've protected their family, their assets, and also their income for the next 20 years. The next one you see below that is what's called a whole life. Whole life policy, as you can see, is a fixed premium that comes into it, and it builds a cash value. Now, whole life kind of goes off of mutual funds, so it's a little bit different than your other types of insurance, but it's something where you can pay into it, and then you can actually collect from it in retirement if need be. The next one on your top right that we're looking at is what's called a universal life. Now, as you can see, that curve goes up very steadily, and the reason it's called universal life, it universally lasts your entire life, and it's a fixed interest rate. So what's happening is as you're putting your premiums in, some is going to the actual cost of insurance, and some is going to a cash value. And that cash value grows over time at a fixed interest rate. So just like an investment that you would have with your bond at a fixed interest rate, this insurance policy has the same. Now, the one thing that life insurance does is it allows you to take out before age 59 and a half or any type of other rules and regulations, as long as you lend it to yourself, and that's the catch. It's called 7707, it's in the IRS tax book, and it's the only code in there that allows you to put money after taxes, grow tax-free, and distribute tax-free at any point after the first year of the policy. So that's for our more conservative investors. As we work our way down on that right side, now you'll see the lines a little bit more squiggly, right? And that's what we call an indexed universal life. An indexed universal life is for someone that wants to have better interest rates than a fixed, but is a little bit wary of the ups and downs of the market. So what they do is they tie it to an index. So who here knows what an index is? Just out of show of hands. Good, good. So the index is an S&P 500, Standard & Poor's 500 top companies in the U.S., measured as a whole, and they see how the companies do, and you're credited an interest rate depending on how those 500 companies do. Russell 2000, that's the 2,000 smallest companies in the U.S. How those companies do, you're measured, and then you get an interest rate. Now the last one here is called the VUL, Variable Universal Life, and you can see that line goes up and down as well, but it's not as steady moving, but it's got some big increases as well. With a variable universal life, this is for someone who wants to take full advantage of the tax 7707 inside of this and put as much cash as possible into the policy and grow that cash value to the point that they'll have a source of income that's non-taxable whenever they want to tap into it. So as you can see, there's a lot of different types of insurance. The term, very cheap. You're almost renting a policy. You're covering your assets and your liability. As you move your way over, it becomes a little bit more aggressive with the whole life, universal life, index, and then variable. All 5 types can be kind of structured into everybody's everyday needs. So it really depends when I sit down with a client on what their budget is, how much coverage they need, and what their end goal is. I sit down with people all the time that say, you know what, all I want is coverage for the next 20 years, get my kids out of the house, I'll be okay, I don't want anything to go on past that. Great, you're a term coverage person. You know what, I need a universal, a fixed interest, I don't really like the market. By the way, can I get long-term care added on to that? Well, absolutely. Universal life's a great idea for you because we can put long-term care and universal life in one page. And what the long-term care will do is actually allow you to use the death benefit as a long-term care benefit if there was an instance when you needed long-term care. So all of those are things that we can put into people's portfolios, and it's something that really I have a passion for because I've sat down with so many people that do need insurance like this. So those are the types of insurance, and so what I wanted to next show you was kind of an idea of, well, how could this be used for other than just if I pass away? So this is what's called a pension maximization strategy. And a pension maximization strategy, and I'm sorry, I didn't grab as many, so if you could do 2 to a person for the big packets. A pension maximization idea is, who here knows what a pension is? Okay, so pension is a paycheck for the rest of your life, much like Social Security. And if you look at it, what we have here is a pension maximization strategy for one of my clients. What it shows is that in this person, at the age of 63, when they retire, what they'll be looking at is they'll actually be getting about $7,400, that's that bold number, $7,400 per month. With a pension, what happens, and I do for a lot of my clients, is when you go into retirement, you have the choice to have your pension pass on to your beneficiary. If you choose not to pass it on, you get that bold number of $7,400. If you decide to pass it on, if you see that box below and you see the 100% option, that 100% option says that monthly you'll be taking home $64.66. You guys see that in the box down there? So what happens is my client here, we'll call her client A, who I'm working on this right now, when she goes in retirement, she has the choice of $7,400 for the rest of her life every single month, or $6,400 every single month, and that will ensure to pass on to her spouse. So she's taking a 17% hit on a monthly paycheck every single month for the rest of her life. Here's the three things that can happen. One, she passes away, her spouse steps in and takes over the policy. Wonderful. Two, what if they both pass away? Pensions only go spouse to spouse. So now what we've done is we've eliminated the heirs and the legacy from getting any of this income. Three, what if they both live to 90 and she gives up $1,000 a month over 30 years, which comes out to $360,000, and then her spouse passes away? Do you think the state of California is going to pay her back that $360,000 she gave up? Not a chance. So what happens is the state's actually asking you to take this insurance policy. And what this insurance policy is that we'll reduce your income by $1,000 every single month just to ensure it goes on to your spouse. Well, what if I could tell you we take that $1,000, put it in your pocket, and out of that $1,000 we take $500 and insure your own private policy that would build cash value, that would pass on to your heirs, and that would never reduce your monthly income. Does that sound like a better idea? 9 times out of 10 people say yes. So that's what a pension maximization strategy is that any time you're going to get a pension, when you go into retirement, you have to make the choice of, do I want it to go to my spouse? And if you say yes, then you're going to get a reduced amount. So what I do for my clients is I look at that reduced amount they're going to lose, put it into their own private policy. Now if their spouse passes away, their children step in. If they both pass away, their children step in. And if they pass away, then their spouse actually collects the entire amount of the pension or the life insurance. And that life insurance will actually recreate their pension for the rest of their life. So that's the idea behind pension maximization. It's just one of the many strategies that we actually have for our clients. So the last thing I just kind of did was, well, life insurance isn't an easy thing to bring up. I say you got to talk about it 2 times a year, and if you don't, you're really missing the boat on this. So what I did was just put together a little worksheet that will allow you to look at target markets, things to look for, phrases, conversation starters, because it's not every day you go over to someone's house and say, hey, how's your life insurance doing, right? That's the last thing we talk about. It's, hey, how the Ducks doing? How the Lakers doing? How was your weekend? What'd you do over the weekend, right? So for this, what I did was kind of show what my target markets are. Families with young children or a mortgage, individuals age 40 or over looking for long-term care, business owners, people that currently own a policy, and people that receive a pension in retirement. So the things to look for: clients who have recently been married, bought a home, or have children, clients who are interested in long-term care insurance for themselves or their parents, family business owners, business partners, clients who have a policy that's 5 years or older, and then clients who will be collecting a pension at retirement. Phrases to listen for: I pay the entire mortgage, or I'm the main source of income, or we're expecting a child. Those are all great things to key in and say, you know what, have you ever looked into protecting yourself with insurance? My parents have long-term care, or I've looked into long-term care. Have you ever sat down with a specialist to help you with that? I have life insurance policy, I get this one all the time. I have no idea what it is. Or I get the statements, I just put them in a file, I never even open them. That is an automatic to sit down with someone and have an audit. And then I'll retire next year and collect my pension, or my company provides a pension. If you hear any of those things, I put conversation starters right below, you can kind of look at it. But really what you'd want to do is just kind of poke and prod. Be more of a facilitator. You know, be like David Delaney. He gets people in there, he sits them down, he said, hey, you got to meet this person, you meet this person. Life insurance is not the easiest thing to bring up with people, and most people don't like to talk about it. But if you're not bringing it up to your friends, you're doing a disservice to them by letting them go out there and not sitting down with someone like a professional like myself. So that being said, my name again is Sina Soltani. I'll be here afterwards, I'll take questions. But thank you very much for your time, I appreciate it.